How does lower tax rates for corporations and for individuals add to whatever stimulus the Fed has been, giving the economy? And is it good or bad for the economy, Jim?
I think it's a really good thing for the economy. Do we need more stimulus? No. Is more stimulus at this point okay? Yes, it is. And when you look at how much rates are going to come down for corporations, it means S&P earnings next year, if it's effective in 2018, will probably jump 20% from this year's number.
Okay. You're on record as saying 20% of a jump next year.
I think you probably get 10 or 12% from the tax bill alone and 8 or 9, 10% underlying growth in earnings. So that's a good thing, particularly with multiples where they are. You need to earn your way into those PE multiples.
Now, you focus on U.S.-based growth stocks specifically, and of course, growth has been outperforming value for quite some time now. I'm wondering if those dynamics start to change between not just the tax bill, but also if we start to get more of an increase in interest rates. And also, of course, we've seen correlations go down for stocks in the S&P 500. Do we see any kind of shift between growth and value?
I think the big question is, where do we settle out on GDP? If GDP is 3% or more, there's a good chance that value does better than growth. If we're still in that 2.5, maybe even 2.75 range, I think growth keeps the momentum and has a good 2018.
Where do you anticipate yields will go, and how flat will the curve get?
I think rates have to go higher. There's no reason, given the economy that we have, that they should be this low. But to be fair, the long end of the curve is dragged down by European rates, by Asian rates. So until they start to move, and they're not going to move for at least another 18 months, if not 2 years, I think the curve gets a heck of a lot flatter.
What's that, though? I mean, do we go to 30 basis points? Do we go to 0?
It could be flat. It could be perfectly flat. I don't think that's a negative for the economy because it's not indicative of what our economy is doing. It's much more about what long rates are around the world versus us pushing up short rates.
I want to get to some of your holdings here that you have in your fund, because you've sort of narrowly underperformed the S&P this year. It looks like Celgene is one of the culprits there. It's stock that's fallen. Most of the stocks, your top 10 holdings, have actually done quite well. What convinces you to rotate out of something when you see that kind of performance? I mean, I don't know what your parameters are, but what allows you to then get out of that stock and look for something better?
Sure. A couple of things. First, we actually have outperformed the S&P this year.
Okay.
But a stock that underperforms, is the story broken? So if we think the story's broken, we're just going to move on even if the price has gone down a lot. If the story's not broken, we'll probably double down on a position. In the case of Celgene, they had a real shortfall in one of their key pipeline drugs. So to us, the value that it dropped by was probably more than what they lost out of the potential. But at the same time, there was a real diminution in value there.